Good morning, ladies and gentlemen. Today is Tuesday, the 6th of July, and once again, we are in this phase of the market where IVs continue to crash, and we are having this almost deeply bullish sentiment, and markets are now assuming that even 15,500 is a very unlikely possibility. And given that scenario, we are seeing that pricing of risk is extremely low. I didn't take a trade yesterday. I posted about it in the morning that I wouldn't be trading. And today as well, I decided to trade, but with a very tight exit criterion. The idea was if market is really going to say that there really isn't much risk, there isn't really going to be much volatility. If that's the assumption, and there's no point in like always saying the market is wrong. So we said, okay, let's test it out, but do it in a way wherein risk is much lower, because this is the worst possible scenario. I posted about the four possible scenarios that can take place in a trade such as mine. And the worst possible scenario is low pricing of risk along with high actual risk. So that was more or less today's trade. The reason I took an exit when I did, rather than sticking to the view even more, is because one, we reached a point which I thought would be a big resistance, and for me to, and from there could be a down move, and that would adversely affect my position. Secondly, there's a lot of open interest built at about 15,800. So that is maximum open interest. And I would think that relatively it is a high likelihood expiry spot. Now, right now, if you are trading at, let us say, 15,870 and the 15,850 straddle is trading at 107, if we do make a down move and head towards 15,800, then that straddle is going to expand at least till about 115, 120 of those numbers. So all that being said and done, I decided to take a quick exit, and I will wait for a better opportunity or a better day to trade, because invariably a day like Monday or Tuesday is not going to be great. Wednesday and Thursday offer much better risk reward for strangling or straddling intraday. So those are the days which I'll have to capitalize more on, and on the remainder of the days I'll have to sort of take it a little easy. Also, if that's the case and there's a high probability of a pullback all the way till 15,800, why not take a position that is delta neutral around 15,800? It would be a bearish position from where we are. The reason I don't want to do that is my open position, which is Bank Nifty almost 100 plus lots, is slightly bearish as it is. And I don't want to also have an intraday trade, which is bearish, because that way, if there is by chance some kind of short cupping and then we hit to a new lifetime high, then I'm screwed on the positional trade also, and I'm screwed on the intraday trade also. So that's one of the way of balancing those two things out. So I hope you had a good trading day, and I will catch you later. Take care.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. The pre-market has settled with a slight cut of 20 points. Looks like so far the 15,800 story continues to hold. And as far as price action on the Nifty is concerned, what I'm looking at is more or less these levels. So we have this gap over here, right? So the Friday's close more or less is going to be a major support factor. But much before that, yesterday's low is also going to be a major factor. So any break which is more than 20 points below 15,800 could lead further long unwinding. And on the upside continues to be a resistance at around 15,840, 850, that range, and post that about 15,900. For now, given current pricing of options, really not much movement is being anticipated all the way till Thursday, with 15,800 yesterday closing at about 125. So 125 up and down is the range that is being looked at. So all said and done, I think the way I would trade a day like today is probably take an at the money straddle and keep a very tight stop loss criteria of about 5 points and take it from there. We'll keep you posted. The time is 9:15. Okay, so I've entered the position and I've kept my position size 1/3 what I usually keep it. And more or less the idea here is on this position I will have about an 8-point stop loss for the at the money straddle. initially tried to enter the 15,800 straddle, but very quickly broke on the first resistance that I was looking at. So broke this resistance and then entered on the 15,850 straddle. Now, more or less, the plan for today is it's trading at 115 or so. So I will keep a stop loss on this for about 7 to 8 points in that range, and that'll be that. The reason for smaller position sizing is because it's just not a very attractive trade, all said and done. So there's no reason to go heavily when it's not exactly a Wednesday or a Thursday when the trade is deeply in your favor. So far we gapped down, but we've made a very strong up move, and most of it is coming from Bank Nifty. Now, Bank Nifty, yesterday I had to make an adjustment to the double calendar, and basically now I am short the 35,200 straddle in the weekly, this 8th weekly, and long the 15th. So we'll keep you posted. Let's see. For now, this has a break even on the upside of about 35,500 on Thursday, so it's relatively comfortable. Okay, so taking a look at this Bank Nifty position post adjustment. Now we continue to make an up move, and currently the break even on just the calendar alone, without considering the rest of the Bank Nifty positions, which is the covered call, is almost 100 points above 35,500. Continue to look very bullish on the Bank Nifty, but there is still a good amount of calls that have been written at 35,500, and they continue to be written. So I'm not of too much concern. So the plan is to keep this position as is for now, despite once again having a relatively negative delta. Now tomorrow, if we gap up over 35,500 and close over 35,500, then that's more or less a good enough criteria to exit for the trade. We've had a big trending move since the calendar, and there's no point fixing it beyond that. But if looked at from perspective of the entire trade, we're doing all right because we have a covered call that is a bullish trade, and as we continue to head higher, that covered call is going to continue to do better. This 35,500 call, which is sold in the weekly for 5 lots to cover the future of 10 lots in the weekly, is currently now at now making a loss. So in case this is in a loss towards tomorrow or day after, and it looks like we're firmly breaking 35,500, then I will do a cost-based rollover. So I'll show you when I do that, because eventually with a covered call, while I'm sending a monthly call and weekly calls, at some point, since the view is also bullish, these calls are going to lose money, and they're going to also become in the money. So at that point, I will do a rollover at the same cost, and I'll go over how that works when I do it. For now, the straddle position is doing all right. We are up about 3 points. Why am I straddling today instead of strangling? So when you have a very tight range in the day, a straddle will work out to be better risk reward, because you won't have to do as many adjustments. When you're anticipating some volatility, like at least about 100 points of volatility, a strangle at least gives you the flexibility to keep moving around. From a straddle position, it's a little bit more of a headache, which is why I would much rather do a straddle today, and that's why sizing is also lower. Okay, IT continues to remain quite weak, and from the entry, I'm up a good 4 points. So I'm gonna call it a day, and yeah, the at the money straddle 15,800 is trading for about 107. Now, I mean, even in the best case scenario, I'm not expecting Thursday morning market to open below 65, 70 points for the at the money straddle. Well, at least 60 points, that much is for sure. And a lot of what has to fall off will probably fall off overnight. There could be further crashing of prices in this, but okay, some massive red candles being formed on Reliance. Anyway, Basically, the idea is really not that much to gain, so I will take the exit. I would much rather sit out. The idea for entry was, okay, enter, keep a very small stop loss, keep the sizing low, and if the trade doesn't work out, get out quickly. The trade did work out, even though it was 1/3 sizing, and I'm happy to take that exit. Okay, one clip to be added. I'm going to be doing another adjustment to my Bank Nifty calendar spread. So without the covered call, this Bank Nifty double calendar where I am potentially at risk on the upside, to adjust it, I will be adding something called a broken wing iron fly, which is nothing but you short the at the money straddle, you buy whichever side you don't want risk, you buy a closer hedge, and whichever side you don't mind the risk, you buy a further away hedge. In this case, my upside is going to push outside my break even. So what I'm doing is, for I'm going to add this spread, but for half the quantity of my calendar sizing. What that will make the position do is, it will add more decay potential, one, and two, it will also give more upside protection because I'm adding a bullish spread to it. It will change my upside break even to 35,700. Of course, it will also pull up my downside break even by 100 points, but it is giving me the upside room, which is what I need now. So this is the position that I will be adding. I'll create a basket on Zerodha to be able to execute it. I mean, this is one of the adjustments which takes additional capital, which is generally what I don't do, but I'm doing it anyway because it's just about 20% more capital than what the trade initially had. So I've entered the position. I'll show you what it looks like. Okay, Bank Nifty. We'll get rid of our covered call position. Get rid of this. Yeah. So this is what the position looks like now. And what this does is, this gives more upside room without adding any upside risk to what was previously there. You'll have to take 5 lots out of consideration in this, because they are part of a different spread, but basically have reduced the upside risk by creating this position, which has fixed profit on the upside, fixed loss on the downside. In the meantime, if we do go down and this makes a loss, my overall position will not make much of a loss because the rest of it is delta negative. So this is one change made, and yeah, we'll catch you tomorrow. Any more changes that I make to this, I'll post on Twitter later. Take care. Okay, one more thing I have to do now is, you know that half my long futures in Bank Nifty 125 quantity, as including the monthly call short to hedge it, I've also shorted the weekly call at 35,500, which is why there's 125 quantity extra in this. What I'm going to do now is, I had sold this call initially at about 125, 130. It is trading at 90, which means that if I book a loss on it, I will be booking a loss of about 60 points. Now, if I want to go cost to cost on it, I will have to just sell a 60-point call in the next week. So basically, very simple. I'm able to roll up my call from 35,500, and wherever I'm getting 60 points, for example, it'll be at 3,700, 37,000, but I'll just add this for reference. Right. So in case I want to go cost to cost on the call, I can book the 60-point loss and then sell the 36,500 call for the next week. So essentially, whatever 60 points loss I'm booking, I'll be taking back. But I want to be a little bit more aggressive than that and continue to collect credit, which is why I'll be selling the 36,000 call of next week. So basically, I'll just be buying this 125. So this is what is called rolling over to the next expiry. You're basically taking in additional credit at a higher strike and rolling up. So whenever your covered call is bleeding, one of the options is, if you just want to go cost to cost on it, you can sell the same premium, whatever premium loss you're booking. For example, I had sold for let us say 130, I'm booking 65 points loss here. So if I want to just collect 65, I can sell the 36,500. That's giving me 1000 points of range and giving me back my 65 points, whatever loss I booked. But since I want to be a little more aggressive in hedging it in case once again there's a down move, I'm selling for 100 points more than what I have lost on it. If you see the first week where I sold the weekly call, it expired worthless. The second week, I'm having to roll it forward and roll it up. And then so every week will either be a combination of the strike that I've sold going in the money, or me just keeping the credit and then selling the same strike again in the next week. So anyway, that's about it. Last clip for the day. Thank you for watching.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.